Hello, everyone. My name is Chris Johnson. I'm a business lawyer and entrepreneur, and I'm also a real estate investor. I have been in one form or another since I was approximately 20 years old. And one of the best ways to build wealth in real estate is through this unique vehicle called a 1031 exchange. It's also called a like-kind exchange. I've seen people amass great amounts of wealth over the decades using 1031 exchanges. So in real estate, and in other investments, you have two forms of making money, and that's essentially cash coming off the investment. In real estate, it would typically be through the form of rents. And then you have the payout at the end when you actually sell the property. And oftentimes real estate doesn't have a really high current return until the end. In the end, there's typically that big payout. And that's typically when you're going to have the highest amount of capital gains or the highest taxable event. So a lot of real estate investors, what they'll do is they'll live very frugally off the income of the real estate investments. They're not really making a whole lot holding the real estate because they know that when they harvest it at the end, then they're going to have a big payout. So they live frugally, they live within their means, they get some income off the property, they manage it well, and then at the end, instead of taking the money off the table, they keep the chips on the table, and they do that through a 1031 exchange, which I'm going to talk to you about more in this presentation. So 1031 exchange, also called the like-kind exchange, it primarily does two things. It defers capital gains and it defers depreciation recapture. So what is a capital gain? Capital gain is the amount above the cost basis for which the principal of the investment increased. So let's keep it really simple. So you have a $100,000 rental home here, and that's the cost basis. And then you have a $300,000 sale of that rental home. So $300,000 minus $100,000 is $200,000. That's your capital gain on selling that investment property. Now, what's the capital gains tax rate? Well, it depends on your income level, and there's some different variations in the capital gains rate. You also have deferral of depreciation recapture for 1031 exchange. And depreciation recapture is what the IRS makes you do at the end when you actually sell an investment property. So the IRS gives you a benefit with real estate. They allow you to depreciate the value of that asset, which allows you to write off income. This is how a lot of wealthy people in real estate own massive real estate holdings, and they end up really paying very little in taxes, is because the depreciation counts as an expense. It's like a loss, but it's not a real cash loss. It's like this hidden loss that the IRS is saying, yeah, we recognize that these improvements, the building is worth less over time, so we're going to let you write that off as if you're taking a loss, even though it's not really a real loss. And it offsets the income on the property, which is a major benefit when you have a lot of income. But then the IRS says, we're not just going to give you a freebie for investing in things like real estate. You're going to have to tack all that expense back on at the end when you actually sell the property. And so the 1031 exchange, as I'll go into, allows you to defer that. I use the words defer. I didn't say you get rid of it. You have to pay the piper eventually, but you can keep pushing it away and away and away and not deal with it now. And I'll show you that you can amass massive amounts of wealth by just not paying taxes right now. So the deferral of the capital gains, let's say that you have a $100,000 property, you sell it for $300,000, that's a $200,000 capital gain. Well, you roll that $300,000 property into another property, and then you don't have to pay the capital gains right now. That capital gains transfers over to that other property, and you're going to eventually have to pay it later, just not right now. And for the depreciation recapture, it's very similar. So if you had a $100,000 rental property and you were able to depreciate, let's say, like $50,000 of that, which wiped out some of the income that was coming off of the property, Well, that'll get batted back onto that $300,000 property at the end, because remember, it's now worth 300,000, so that's 350. But you can defer that extra 50,000 onto that next property, onto this later date, and you'll just deal with it later. And we'll talk about what later exactly means. So what are the requirements for a like-kind exchange? Has to be a business or investment property. There has to actually be a like-kind exchange. So similar property for similar property, it's pretty easy to meet those requirements as long as it's investment property. And there's some timing requirements. You have to identify the replacement property within 45 days, and you have to close on that replacement property within 180 days. So let's talk about what that means. So I have my $100,000 investment property. I sell it for $300,000, and then I'm like, oh gosh, I don't want to pay capital gains on this, and I don't want to pay my depreciation recapture. So let me find a replacement like-kind property. So I go out and find another single-family rental property, but this time it's for $350,000. Let's do capital gains plus that depreciation recapture that I'm trying to shift over. And then I'm going to identify that property within 45 days of selling my original property. And then I'm going to actually close on that $300,000 property within 180 days. So that's essentially how the 1031 works with respect to the timing issue. Don't fret if you end up buying a new property before you sell the original one. You can do what is called a reverse exchange. So what you do is you have your $100,000 property. It's a great property. You haven't even thought about selling it. It's now worth $300,000. And you go ahead and you buy a $300,000 property because you're like, I really like these single family rentals and I'm doing really well on it. So you buy this new one, and then you realize, wow, I have a lot of gains in this other property. So I'd like to harvest the gains without realizing tax hit. So what I'm going to do is a reverse exchange. Even though I now own two properties, I'm going to go ahead and within 45 days of buying this new $300,000 property, I'm going to identify this $100,000 one that I already owned. I'm going to identify it within 45 days, and then I'm going to sell it within 180 days. And if I do that, then I qualify for the reverse exchange. So I'm going to show you in a graphical form what a 1031 does for you. So this is assuming $1 million investment property. Let's just talk about $1 million principal. There's a steady growth rate of 5% annual growth rate a year and a 20% capital gain tax rate. So the green line is the 1031 exchange. The blue line is if you're having to pay taxes each time. So you can see the properties going up in value, and then every time you sell it, it goes down. Every time you sell it, it goes down. Every time you sell it, it goes down. Even though it goes up, it's like 2 steps forward, 1 step back. But with 1031 exchange, it's just 2 steps forward, 2 steps forward, 2 steps forward, 2 steps forward. And that compounds over time. So you can see that green line is exponentially getting larger than the blue line, which is kind of more of like a steady increase, where the green line is zipping up at a more exponential rate. So let's look at the actual numbers on this. So if you look at you can see amount increased on year one is $50,000 because that's a 5% increase off $1 million principal. The new value is $1,050,000. The actual value of the property after a 1031 exchange is $1,050,000, because remember, you're just taking 2 steps forward. You don't have to take a tax hit off. So at the end of 25 years, it's $3,386,000 approximately, and some change. So if we look at this last column, and then we look at the next slide, that last column really goes down to this somewhat middle column. It's called new value. So you can look and see kind of that's where you're at. That's no taxes at all. Beautiful thing. And then if you had to apply a capital gain tax rate of 20% each time to that increase in principal value, we were paying $210,000 tax the first year, $220,000 tax the second year, $231,000 the third year, etc., which drastically reduces your principal value to $840,000 in the first year, $882,000 the second year, $926,000 the third year, so forth, so forth. So you can see on that column, it's $2,709,000 as opposed to $3,386,000, which is a difference of $670,000, which is substantial. Paying taxes prevents you essentially from the full benefit of compounding your earnings and the value of your property over time and being a smart investor. Instead, you're being penalized. The IRS loves this. They're just taxing you, taxing you, taxing you. You want to defer the taxes, which a lot of investors do. It's a very, very common strategy. The logical end to this is, well, can I just defer forever? I mean, at some point you got to pay the piper, right? And the answer is yes. So what happens is eventually you die. When you die, you got to pay the piper. So your estate, everything's going to step up. So let's say you had a $100,000 investment property. That was our original example. And over time, you kept rolling that thing into property after property after property. That's $10 million. So $10 million is essentially all that would be deferred gains because you only started with $100,000. But what's going to happen is the $10 million, the value of those properties the cost basis will step up to fair market value for your heirs. So that's good. They won't be taxed again, but your estate will have to pay a tax on that $9 million. Now, currently, there's an exemption, and it's approximately $12 million for a single person, and then $12 million for each of the spouses for married, which is substantial. This exemption is going to sunset in 2026. So what does that mean? So right now, under that example, if you had 9 million plus in capital gains that you deferred over time, well, it doesn't matter. You have an exemption that's under the 12 million. So you're good. All right. You don't have to pay any taxes on that. So that's great. Now, if it sunsets to a lower amount, let's say 5 million, well, you're going to have to pay estate taxes on that 9 million plus minus 5 million, and 40% of that, which is going to be a substantial amount. So it all depends on how much you're deferring over time. And it also depends on what the current estate tax rate is. Then it also added another variable that's beyond the scope of this presentation. It depends on how you do your other things in your estate planning, whether you've planned well for the future and doing other things to avoid your estate tax liability to your heirs. So is it hard to do a 1031 exchange? I have potential clients reach out to me and they're like, I need help with the 1031 exchange. I have accountants come to me and say, we have a client that needs help with the 1031 exchange. Clients oftentimes think that they need help either from an accountant or from a lawyer. And here's the reality of things. There might be some things that are really super, super complicated that a lawyer or an accountant needs to do research into. But typically, generally, these are really pretty simple transactions. You just need a 1031 intermediary. And IPX 1031 is a company that I refer out to people, and I refer them out because they are a subsidiary of Fidelity National Title, and I underwrite exclusively through Fidelity National Title. They're one of the largest in the countries, and they have a great reputation. They've been around for a while, and IPX 1031 has done a great job for my clients. So that's who I refer out to, and I'm showing that website in case anyone needs that information. So let's talk about the possible tax changes when we're dealing with these sunsets of estate tax. So again, in 2026, you're going to have some sunsetting. So it's going to go to 6 million for a single person and 12 million for a married person. And it could go less than that over time, depending on which politicians are in power, right? It could go more too. They could put a higher exemption in place like they've done with past administrations. The Biden administration wants to limit the 1031 deferral amount to $500,000. So he wants to put a real cap on that in addition to lowering that estate tax threshold. So what does that mean again? It means be proactive in your estate planning. So there's some like real estate tax strategy type things involved with this. So it's not really heavy on the legal, but what is heavy on the legal is the rest of your estate plan, asset protection strategies, and they all need to work together. You should work with an advisor that doesn't understand just legal and doesn't understand just tax, but understands all of it. That can give you a holistic plan to help avoid these situations and plan well for your future. The last slide has my contact information if you want to talk about 1031 exchanges, title, real estate investments, any of those things. You can scan that QR code, goes directly to my calendar, and I invite anyone to take a 15-minute consultation with me. Also has my email address. Feel free to email me. It's chris@fidelitylakehouston.com. And I hope that you learned a lot from this presentation. You have a good day. Thanks.